Let's get back to jobs here for a hot second and going deeper into today's numbers. Transportation and warehousing jobs seeing some of the largest gains. It's great news for analysts watching for a rebound in those sectors as the economy continues to recover from the pandemic. Let's talk about why these numbers matter to the larger economy with Rob Dent, Nomura Securities senior U.S. economist. And perhaps you can start by breaking that down for us, why it does matter to the larger economy.
Yeah, look, I think the first place to start with this jobs report is just to say it's very, very strong, right? We had over 400,000 jobs added in the month of April. We think that's about 4 times the sustainable pace that you need to keep up with labor force growth. And so the labor market really isn't showing signs of a sustained slowdown. Labor demand is still very high. I think everything is moving in a pretty healthy direction. And so it really is kind of a key measure of how the economy is doing more broadly. And we think underlying momentum right now is just very, very firm. Now, that being said, there were still a couple of concerning signs. The first being labor force participation did edge back down a little bit in April, which is kind of a concerning sign when you're thinking about the labor supply really needs to come back to kind of ease some of these wage pressures that we're seeing. And so, this is one of those reports where it's not all cut and dry. Not everything moved in the same direction. It takes a little bit more nuance to kind of parse through the numbers.
I want to ask a little bit more about that easing of wage pressures you were talking about, although the participation question is also an important one. But we keep talking about easing wage pressures when wages are rising 5.5% year over year and headline inflation is rising 8.5% year over year. So if we're slowing down that wage growth, isn't that going to be problematic for a lot of folks?
Yes. And I think right now, one big issue facing consumers is that real wage growth, as you noted, is negative. It has been negative for the past couple of months. Now, that being said, we do expect kind of headline CPI inflation to moderate over the next couple of months, just because energy prices are unlikely to keep rising as rapidly as they did following the invasion of Ukraine. In addition, we would still point out, when you look at wage growth by income distribution, lower earning households are still seeing the largest increases in wage growth. I think even some of those households might be experiencing positive real wage growth. And so it's not a clean story across the income distribution overall. And then finally, while we did see wage growth moderate for the top line numbers in April, when you look by industry, it was a little bit more complicated. Retail wages actually declined pretty sharply by 0.4 month over month. But professional and service wages, which are kind of the big driving factor for the service industry overall, those increased by about 0.6 month over month. Those have been firming pretty steadily recently. And so we're seeing kind of a much more strong trend of aggregate wage growth overall.
Robert, the large down day we saw in markets, and again, we're seeing that continue today here with pressure on markets again today. Do you think that is the market saying it's nervous that the Federal Reserve will send the U.S. economy into recession?
I think that's part of it. I think right now investors have to kind of weigh the two outcomes we are facing, which is basically a soft landing where the Fed can get inflation under control without driving the economy into a recession, and a hard landing where the Fed has to over tighten and push growth into negative territory. I also think part of what's going on is that markets may have focused a little bit too much on Chair Powell's comments on Wednesday, pushing back against 75 basis point hikes, and missed the broader point of the meeting, which was that the Fed is still very much in kind of a mode of whatever it takes to get inflation under control. I think they are prepared to hike rates very, very aggressively to a constrictive level. Our forecast for the terminal rate remains above the market implied level. We're looking for 3.75 to 4% by the middle of next year. And so I think part of what you're seeing is a reevaluation of what the Fed told us on Wednesday, and it's still a very, very hawkish message.
And Robert, just quickly, which camp are you in, hard landing or soft?
So we still are forecasting a soft landing, but with some nuances. We do think growth is going to slow pretty significantly to kind of under 1% consistently next year. We also think the unemployment rate is likely to increase from a trough of around 3.3% at the end of this year to around 4.2% in 2024. And so it's a soft landing, but I would say with some turbulence along the way. And we're very cognizant of the risk that we could end up in that hard landing scenario. We have pegged that risk at around 35 to 40% by the end of 2024. And so we're definitely not out of the woods yet.
All right, Robert Dent, thank you so much. Nomura Securities senior U.S. economist. Good to catch up with you.